Most builders think that they know their gross profit. They'll say, yeah, we're sitting around 30%. But for most of you, that number isn't correct. And that's because your P&L is lying to you. And it's not because your bookkeeper is bad at their job, it's because of the way that your QuickBooks file is structured. You see, the default QuickBooks structure is built for generic small businesses and not built for a construction business. So unless someone who really understands construction business financials has gone in and adjusted it, the chances are your costs are being reported in the wrong places. I've coached construction businesses for 8 years and reviewed hundreds of P&Ls. And I can literally count on one hand how many didn't need a restructure. And that's not on you, that's just how it works out of the box. So today, I'm breaking down exactly how your QuickBooks should be set up, the 5 sections, the correct structure, and the 5 golden rules to keep your numbers honest. And if you want the correct P&L structure, click the link in the description below. Hey, I'm Brian. I was a professional remodeler and custom home builder for over 21 years, and with 2 parents as accountants, I was basically raised on numbers. So let's start by breaking down the 5 sections of the P&L. Income is what comes into your business from all construction activities. Cost of goods sold are the direct cost to perform the work. Gross profit is what's left after you subtract your cost of goods from your income. Overhead is all non-job related costs required to run the business. And net profit is the bottom line after everything and everyone's been paid. Each section stacks on the one above it, and each section has a job to do. When the structure is right, the report tells you exactly where your business stands. But when it's wrong, you're pricing jobs based on a gross profit number that isn't real. And that is how builders lose tens of thousands of dollars every single year without even knowing it. So let's go through each one, starting with income. This is the top of the P&L and it's the simplest section to get right. Income is everything coming into your business based on construction activity. And for most builders, that's just one account, sales. That said, if you offer pre-construction or any other distinct services, then you can have a second or possibly even a third income account. But just keep it simple. The mistake I see builders make is overcomplicating this section when all that really matters is the total. From income, we move down to cost of goods sold, and this is the part where most P&Ls start to break down. Cost of goods sold is every direct cost that goes into performing the work. If it touches the job, it lives here. Now, there are 3 main cost of goods accounts that you should see in a construction business: labor, materials, and trades. And then there is a 4th account called other costs for direct project costs that don't fit cleanly into the other 3. Now here is why getting this right matters. Your total cost of goods should sit between 67 to 78% of your total income. If costs that belong here are sitting somewhere else in your P&L, the percent is wrong and every decision you make based on it is wrong as well. And this is where most QuickBooks accounts are broken right out of the box. The default supplies account in QuickBooks is mapped to expenses. That means every time your bookkeeper codes a material receipt to this account, they're putting it into the overhead side of your P&L. That means your COGS go down, your gross profit goes up, and your P&L is telling you you're more profitable than you are. The same thing happens with payroll. QuickBooks defaults payroll, wages, and taxes to expenses. But your field employees are a direct job cost, and their costs belong in COGS. Now the good news is that you can map each employee through QuickBooks so that each of their wages and taxes land in the cost of goods category or the expenses category, depending on if they are a cost of goods or an overhead expense. And if you want to know exactly how to set that up, I put the link in the description below. And one more that I see regularly is engineering and other professional consultants that we hire on projects being placed in the professional fees category in expenses. If someone is working directly on your projects and you issue them a 1099 or a T5018, then they are an independent contractor. That means they belong as a trade partner on your income statement. Now, every one of those mistakes does the exact same thing I just explained. It pulls costs out of the COGS, inflates your gross profit, and tells you a story that isn't true. Now let's look at how the accounts should be structured. Labor is where the parent-child account structure is first introduced here. You see, in QuickBooks, you can nest accounts under a parent account. So instead of one flat labor line, you can nest sub-accounts under the parent account for wages, taxes, workers' compensation, and health benefits. This keeps everything under one roof while still giving you the detail that you need. You'll see the same structure come up again when we get into overhead in a minute. The other accounts are materials, which captures every single product that you purchase for the project, and trade partners, which is your spot for any of your 1099 or T5018 subcontractors that you hire. Now, I also mentioned the 4th cost of goods account called other accounts, and this allows you to place things that don't quite fit as a 1099 or a T5018, things like equipment rental, disposal, blueprints, and copies. So if it's clearly a direct project cost but it doesn't fit into labor, materials, or trades, then put it into other costs. Next down from cost of goods is gross profit. The formula is simple: total income minus total COGS. This number tells you what you made on the project before overhead kicks in. Tracking this KPI or key performance indicator is crucial to understanding that you have enough to contribute to your overhead and net profit. For cost plus builders, a healthy gross profit range is between 22 and 26%. For fixed price builders, you should be aiming between 30 to 33%. Honestly, knowing your gross profit is one of the most important KPIs in a construction business. But here's the thing, when you have labor, materials, and trade partners that are direct project costs sitting in expenses, your gross profit is going to look higher than it actually is. And when it looks healthy, you start making decisions based on it. You'll likely price your markup more aggressively because you think that you have room. But when you look at your net profit bottom line, you're wondering where all the money went. And that leads you to start thinking about cutting overhead. But overhead was never the problem. The problem was that your gross profit was not as strong as your P&L told you. That's the lie playing out in real time. And that's why getting your COGS structure correct is so important. Again, if you want to grab the correct structure, click the link in the description below. Now we move into overhead, but in QuickBooks they actually call this expenses. Same thing, different name. Overhead is every cost that keeps your business running whether or not you have a project. Your office, software, vehicle, insurance, to name a few. If it's not tied directly to producing the work, then it's an overhead cost. And just like we saw in COGS, these costs also end up in the wrong place sometimes as well. Take tools for an example. Tools you buy for your business are an overhead expense, but consumables like drill bits, saw blades, sandpaper, etc. are all consumables and should live in the cost of goods section. And this all depends on whether the item gets completely used up or comes back to the shop after the job. A well-run construction business runs overhead between 5 and 15% of total revenue. If you're sitting above that, there's a good chance that that is eating into your net profit. And if your COGS structure is wrong, you'll actually never know if overhead is the problem. That is why we fix the structure first. So now, let's talk about 5 golden rules that you can use to keep your overhead section clean. Rule number 1, don't put any costs in a parent account where a parent-child relationship exists. If you have child accounts set up under a parent, then every transaction goes into a child account. Rule number 2, name your account so anyone knows what transactions live inside of it without having to click into it. Not the default QuickBooks names and not the default settings that your bookkeeper set up. If you can't tell what's inside of an account by just reading the name, then the name is wrong. Rule number 3, group things together logically. Take professional fees as an example. Instead of one flat professional fees account, you set up a parent account with child accounts for accounting, bookkeeping, legal, and coaching. That way, when you collapse the view in QuickBooks, you see one clean line, but you still have the detail that you need when you expand it. Rule number 4, make problem accounts inactive. This will stop transactions from landing in the wrong place on a consistent basis. The supplies account that we spoke about a minute ago is a great example. Make it inactive and the miscategorization stops. And rule number 5, review your P&L regularly. Things will drift over time. A transaction lands in the wrong account, a new expense gets miscoded, and before long, the structure that you built begins to break down. Check in monthly and get your bookkeeper to correct course before it gets out of hand. And that brings us to the bottom of your P&L, net profit. This is what you actually get to keep after all of the job costs and all your overhead are paid. Now, before we talk about what a healthy net profit looks like, we need to address owner's compensation. If you're on salary, your compensation is going to show up in the overhead section. But if you're taking distributions or dividends, they won't. And that means that your pay is coming out of the net profit number. That changes how you read this. Now, you might be wondering, how much should you really be paying yourself? You can use the rule of 20, 10% for owner's compensation and 10% for net profit. So if your business is doing $2 million a year, you should have the ability to pay yourself $200K and also have $200K left in net profit at the end of the year. Now, there is some flex in that number. Not every business owner is going to take the full 10%, and a healthy net profit can still be around the 8% mark. But if you're below that number in the bottom line, but your gross profit is telling you a different story, then it's time to go back to the COGS section and see if you have any of these critical mistakes that we've covered in today's video, because that's almost always where the answer is hiding. Now, before we wrap up, there are 2 other lines of your P&L that are worth mentioning here: other income and other expenses. They capture things like interest on corporate accounts and tax adjustments. They live here, so they factor into your bottom line number without distorting your overhead ratio to total income as well as your gross profit. Now, here's the thing. Everything we just went through, the 5 sections, the correct structure, and the 5 golden rules, none of it matters if you're still set up on the default settings in QuickBooks. The template in the description below is correctly structured for a construction business. Download it, hand it to your bookkeeper, and have the conversation, because your P&L should be telling you the truth. And now you know exactly what to look for when it's not. If you found this video helpful, please subscribe and share with someone who's tired of being lied to. Thanks for watching. We'll see you next time.